Morning. Top Gun here, about 3 a.m. Pacific Standard Time, Thursday, February 25th. This is the YouTube pre-market commentary. All right, let's do a little recent history first. So on Saturday's morning vlog, I talked about how the 15 basis point rise in the 10-year Treasury yield last week was the big story of the week. Now, stocks didn't really respond much last week. The S&P was down about 0.7% in what Scott Redler characterized as a digestion week after two really powerful up weeks. But they did start to respond on Monday and Tuesday morning, selling off dramatically. In fact, the NASDAQ hit 13,000 and was down 4% 20 minutes into Tuesday's session after a drubbing on Monday as well. And it looked like the bears had taken control. But once again, it was short-lived, and the bulls rallied the market almost all the way back to break even on Tuesday. And then yesterday it was another, sort of a par for the course 2021 day, with the S&P up 1.14%, the NASDAQ 0.99%, and the Russell 2.38%. It's like Monday and Tuesday morning didn't even happen. It's just back to the races, I guess. Which shows that the bears don't have much power, to quote the great short-term trader and technician Scott Redler. Nevertheless, interest rates continue to rise, as you can see in this chart this tweet that I posted from Cornell professor Dave Collum. The 10-year yield ended last week at about 1.35, and it closed yesterday at about 1.39. So it continues to creep up 4 basis points more in the last 3 days, 19 basis points in the last 8 days. So, as I talked about in one of the blog posts, I think the blog post on Tuesday morning, rising interest rates affect growth stocks whose earnings are farther in the future, far more than value stocks whose earnings are more in the present, because you have to discount them. So as the discount rate rises, those future earnings become less valuable, which is why growth stocks got hit so hard on Monday and Tuesday morning. So that's still happening. Whether the Fed has lost control of the bond market or is losing control, as Collum suggests, I'm not so sure. I think it's the rise is a combination of investors' belief that economic growth is going to pick up, but I also think there's concerns about inflation. And if we do have inflation, that's when the Fed loses control of the long end of the yield curve. Nvidia, the seventh most important stock in the market, in my opinion, reported earnings yesterday afternoon, and as expected, they were stellar. Revenue was up 61%, and non-GAAP diluted EPS 64%. You can't do much better than that. However, Nvidia shares were unable to get much traction in the after hours because it's trading at 56 times enterprise value to trailing 12-month EPS. And I use enterprise value to actually help Nvidia because it gives them credit for their net cash position. If you use actual price, the price to earnings ratio, the numbers actually higher. But I think EV is the right metric to use. So let's see how Nvidia does today, because it could give us a tell on if the market sees any limits to tech valuations. And we're gonna get a repeat this afternoon when Salesforce reports. Again, I expect a solid quarter, but Salesforce is trading at an enterprise value to trailing 12 months EPS of 51 times. So, a lot of good news is priced in. How much higher can shares go? How much higher can valuations go? So let's keep an eye on the 10-year yield. Let's keep an eye on Nvidia, and then let's take a look at Salesforce this afternoon. I see you guys on Friday.